Okay, let's unpack this. Imagine, if you will, a shiny new motorcycle just zooming down a highway. It's sleek, powerful, it's turning heads. That's kind of the electrifying energy we're seeing in India's economy right now in 2025.
It really is. That's a great image.
And today we're diving deep into the corporate and banking sectors there. It's a story of, well, unprecedented growth, record profits, soaring stock markets.
A truly remarkable picture. And this is where it gets really interesting. Our mission today isn't just to, celebrate all that success.
Oh,
We're going to try and dissect India's good problems.
Yeah.
These are the unique challenges that actually pop up when things are going so well, almost too well, that you start looking for potential speed bumps.
Exactly. Like, what could go wrong here?
Precisely. We'll explore why valuations are sky high, why foreign investors seem a bit, let's say, cautious, maybe playing hard to get, and even why some really profitable companies are kind of hitting the brakes on new investments.
Yeah, it's not your typical economic doom and gloom. It's more navigating the paradox of success. So get ready for some maybe surprising facts and perhaps a few aha moments as we decode these signals.
Signals that really demand a sharp eye.
So what do these good problems actually mean for the future of, well, one of the world's fastest growing major economies? Let's take this deep dive. Our journey starts, I think, in a place that feels like a massive celebration. Picture India's corporate scene, like a vibrant Diwali bash.
Good analogy.
Lights flashing, music pumping, everyone's showing off their best moves, metaphorically speaking. And the numbers back this up, don't they?
Oh, absolutely. India's nominal GDP is projected for 2025 to hit something like $4.187 trillion. Just think about that number.
Wow.
It means India is set to become the world's fourth largest economy, overtaking Japan.
That's huge, and it's the corporate sector really driving this, right? Profits soaring.
Exactly. They're leading the charge. And a really significant catalyst behind this, something we should probably touch on, is the Insolvency and Bankruptcy Code, the IBC.
Ah, yes, the IBC. Came in around 2016.
That's right. Think of it like a strict but fair bouncer at the club. It's been really effective at dealing with bad loans, kicking them out, and helping banks recover more cash.
So cleaning up the system.
Fundamentally, by March 2025, the resolution rates under the IBC hit 32% of admitted claims. That's a serious improvement in, let's call it, financial hygiene.
A powerful cleanup indeed. So with all this new financial strength, what are companies actually doing?
Well, they seem to be treating their shareholders like royalty.
Cool.
We're seeing an incredible pace of dividend payouts, lots of share buybacks. It's like they're flush with cash and giving it back.
And the stock market's loving it, presumably. Sensex, Nifty.
Absolutely reflecting that confidence. Both the BSE Sensex and the Nifty 50 have been, flirting with all-time highs. The Sensex even touched 82,000 recently. You can really feel that optimism.
Okay, and what about the banks themselves? Are they healthier too?
That's what's really encouraging. The strength is mirrored in the banking sector. Those non-performing assets, NPAs, the bad loans, they've plummeted.
How far down?
To a 10-year low, just 2.8% as of March 2025. Remember, back in 2018, it was a crippling 11.2%.
Wow, that's a massive shift. Shows real fundamental strengthening.
It does, in India's financial core.
Okay, so everything looks fantastic on the surface. Profits up, banks healthy, market booming. But, and there's always a but, isn't there?
Usually is, yes.
Before we pop the champagne, or maybe the mango lassi,
Yeah.
let's talk about those uninvited guests at the party, these unique challenges that success itself brings.
With good problems.
Exactly. Those sky-high valuations everyone's talking about, the slightly hesitant foreign investors, and maybe most paradoxically, successful companies tapping the brakes on new investment. These need a sharp eye, right?
Absolutely. They demand careful management. So let's tackle the first one. Valuations so high, they seem to need oxygen.
Right. Like a Bollywood star's fee. Eye-wateringly high.
Huh. That's one way to put it. Makes everyone wonder if it's worth it. Look at the numbers. The price to earnings, or PE ratio, for the Nifty 50 is hovering around 24 right now.
And how does that compare globally?
Well, compare that to maybe 15 for China's Shanghai Composite, or around 18 for the S&P 500 in the US. Investors are clearly paying a hefty premium for Indian stocks.
Betting big on future growth then, like it's a sure thing.
Like it's a guaranteed win, exactly. But here's the risk, the catch.
Go on.
High valuations means stocks are pricey. Simple as that. If the actual company earnings don't keep up with that hype.
The market could wobble, Like a cycle rickshaw on a bad road.
Precisely. It could face a significant correction. And look at India's market cap to GDP ratio. It's around 140%.
Which is high.
Higher than most emerging markets, even higher than some developed ones. It signals confidence, sure, but it's also a bit of a warning light.
And what about external threats? Global stuff.
That's the other factor. If global interest rates suddenly spike, or if a major geopolitical crisis hits harder, say, things escalate further between Iran and Israel, pushing oil prices up.
Investors might ditch these pricey stocks.
They might pull back very quickly, faster than a bad Tinder date, as the saying goes. Honestly, Indian stocks feel almost like a luxury item right now. You hear analysts whispering correction like it's a forbidden word.
So for you, the listener, maybe time to think about diversification before the market throws a tantrum.
That's a really crucial point. So how do you manage these high valuations? Well, companies, for their part, they just have to keep delivering those strong earnings to justify the price tags.
Makes sense. What about the government?
The government can help by maybe boosting sectors where valuations are a bit more grounded, like manufacturing. Capital goods stocks, for instance, have a PE closer to 18.
So not everything is sky high.
No. And what's interesting is while IT and consumer goods are driving that high nifty PE with strong earnings, the real froth seems to be in the mid and small cap stocks. Their PEs are nearing 30.
So those could be more vulnerable if things wobble.
Potentially, yes. Very vulnerable if global markets falter.
So for individual investors tuning in, what's the smartest ploy here?
The advice is pretty clear. Spread your bets. Don't put all your eggs in one basket, especially not just in those high-flying tech stocks. Maybe look at allocating some capital to bonds, maybe even gold.
And what about all the new domestic investors piling in through SIPs?
That's another huge factor. We're seeing over $2.2 billion coming in monthly from retail investors via these systematic investment plans. It's fantastic participation, but it's absolutely vital that this growing pool of investors has strong financial literacy to avoid that classic painful buy high, sell low scenario.
Education is key.
And regulators are also, thankfully, tightening controls on speculative trading, which might help cool down some of the hotter segments. It's about being strategic, maybe looking at undervalued areas, like some public sector banks. Their PEs are much more modest, around 10, 12.
That's a really pragmatic view. Okay, let's shift gears to the second good problem. Foreign investors playing hard to get.
Ah, yes, the FPIs.
Foreign portfolio investors. They seem to be acting like that friend who says yes to the party invite, but then, bails at the last minute.
That captures it well. Despite India's stock market hitting these peaks, FPIs actually pulled out net about $2.5 billion from equities in the last quarter, April to June 2025.
Which is quite a contrast to domestic investors.
A stark contrast. Domestic investors poured in $3.4 billion in the same period. And remember, just last year, 2023, FPIs were huge net buyers to the tune of $20 billion.
So what's changed? Why the cold shoulder now?
Well, partly it's those high valuations we just discussed. They spook some global players. But it's also broader global uncertainties.
Like what?
The U.S. Federal Reserve stance, for one, they're hinting at keeping monetary policy tight, maybe even tighter. That makes safe U.S. bonds look, well, tastier than potentially volatile Indian equities for some big funds.
Makes sense. And geopolitics. You mentioned Iran-Israel earlier.
Right. Exactly. Those ongoing tensions, the strikes. It raises real fears about oil prices. India imports a lot of oil.
The import bill is huge already, right? $200 billion.
Annually, yes. If Brent crude oil crosses, say, $90 a barrel for a sustained period, that bill swells. It squeezes corporate profit margins and, frankly, scares off some FPIs who worry about inflation and currency risk.
So it feels like FPIs see the Indian buffet, they like the spread, but they're not quite sure they want to commit to the whole meal. Worried about indigestion later.
That's a good way to put it. Meanwhile, Indian mutual funds are like, great, more loot-ticky for us.
So what can India actually do to make itself more irresistible to that long-term foreign money?
That's the million-dollar question, or rather, billion-dollar question. India can't control global drama, obviously,
right,
but it can enhance its own appeal. Things like easing foreign direct investment, FDI, rules in key sectors insurance, defense could attract more stable long-term capital, not just the hot money.
So focus on the long game.
Exactly. And the Reserve Bank of India's stable rupee policy helps too. Keeping the INR around 83.84 to the US dollar gives a sense of predictability. Plus, just keep those reforms coming, simpler taxes, less red tape. That convinces FPIs you're serious about making it easy to do business.
And things like the G20 presidency, is that an opportunity?
A prime opportunity. It's a global stage to showcase the economic story, engage directly with investors. The message needs to be clear. India's growth, consistently around 7% GDP, isn't just a fluke. It's built on resilience and real opportunity.
Making India an essential destination, not just an optional one. Okay, that makes sense. Now let's tackle the third good problem, which feels the most paradoxical to me.
The investment slowdown.
Yeah, companies hitting the investment brakes. India's corporate sector is like that brilliant student who aced the exam but then isn't sure about signing up for the advanced, harder classes.
Explain that a bit more.
Well, factories are busy, right? Capacity utilization, how much of the factory is actually being used, is at a healthy 76%. They're humming along.
Okay, that sounds good.
But investment plans for the next year, 2025-26, are actually shrinking. Private capital expenditure CapEx, spending on new factories, equipment, it's projected to grow only 8%. That's down from 12% the previous year.
A noticeable slowdown.
And new project announcements, down 20%. Only about 5 lakh crore rupees announced for the next fiscal year. So companies are profitable, factories are busy, but they're not investing as much in future growth. Why?
Well, some of the usual suspects are at play again. Geopolitical risks we've mentioned. High borrowing costs, too.
Even with the RBI holding rates steady.
Yes, the RBI's key repo rate is 6.5%, but global rate hikes are pushing up the actual cost of loans. SBI's base lending rate, the MCLR, is up around 8.59%. That makes big new projects more expensive to finance.
And politics. Elections.
That's often a factor. With key state elections, like in Uttar Pradesh, looming in 2026, companies tend to play it a bit safe. They wait for policy clarity before making big, long-term bets.
Understandable, but what's the impact? Especially on jobs.
That's the major concern. This slowdown in investment could really hurt job creation. India needs something like 12 million new jobs every single year just to absorb people entering the workforce.
12 million.
It's a huge number. Muted investment means fewer new factories, fewer new roles. Urban unemployment is already hovering around 6.8%. And while the gig economy is growing fast, maybe 10 million workers now.
Those jobs often lack security, don't they?
Exactly. They don't always offer the stable, long-term employment that many people need.
So it feels like CEOs are sitting on these big cash piles, like dragons guarding gold.
Huh.
But no one's quite ready to slay the wait-and-watch beast and spend it. Is it just caution or something deeper? Do they need a nudge, some tax breaks perhaps?
That's the critical challenge. What can actually ignite this private investment cycle? Well, the government's already doing quite a bit with its massive infrastructure. Push $125 billion on highways, ports, bullet trains.
The idea being that public spending will crowd in private spending.
That's the theory, yes. Tax incentives specifically for greenfield projects, brand new factories, could also spark capex. The RBI might need to think about easing liquidity a bit, maybe a small rate cut, just 25 basis points to make borrowings slightly cheaper.
And preparing the workforce.
Crucial. Investing in skilling programs like the PM Kaushal Vikas Yojana ensures that when the jobs do come, people have the right skills. And schemes like the Production-Linked Incentive, PLI, seem to be working. That they've dispersed around 2 lakh crore by now, driving manufacturing investment.
Any other levers? Tax, red tape.
Definitely. Lowering the GST, the goods and services tax, on capital goods like machinery, maybe from 18% down to 12%, that could help. And ultimately, state governments have a huge role. Places like Uttar Pradesh, Gujarat, Tamil Nadu, they need to really fast-track approvals for land, power, permits for new factories, get rid of the bottlenecks on the ground.
Right. Okay, so let's try and synthesize all this, bringing it together. India's corporate and banking sectors, they feel like a cricket team on a winning streak.
I like that.
Batting strong, scoring runs, but maybe always wary of a sudden middle-order collapse.
Yes, that captures the tension. The IBC cleaned up the bad loan mess, no doubt. Profits are fueling these incredible market rallies. Banks are healthier than they've been in ages, but
those good problems, high valuations, jumpy foreign investors, sluggish capex, they need really smart plays to keep the scoreboard ticking over, right?
Precisely. You can't get complacent. The government and the RBI, they certainly have tools in their kit. Fiscal measures like that big capex budget of 2.7 lakh for 2025-26 can boost growth directly.
And monetary policy, liquidity.
They could ease liquidity, maybe cutting the cash reserve ratio, the CRR, just slightly, say from 4.5% to 4%, that could free up maybe another 1 lakh crore for banks to lend out.
But it's always a balancing act, isn't it? You ease too much.
Exactly. Too much cash sloshing around could just stoke inflation again, which was already nudging up at 5.2% in May. So it's not just about opening the taps, it's about calibrated strategic moves.
It really does feel like India's economy in 2025 is like maybe a T20 match.
Let's go on.
Thrilling, high scoring, lots of boundaries, but you're always, just one bad over away from a real nail-biter finish.
That's a fantastic analogy. It sums it up perfectly. It's about playing smart, keeping the runs coming, but also protecting your wickets, navigating those subtle shifts with real precision.
So we've taken quite a joyride today through India's really vibrant economic landscape. We explored the astounding growth, but also these fascinating good problems that seem to come hand in hand with rapid success.
From those sky-high valuations needing a careful eye,
To the cautious foreign investors and even successful companies hitting the investment brakes. It's clear, isn't it? Well, the party's definitely lit, as they say.
yes.
Vigilance and really smart strategy are absolutely key. India's corporate story is shaping up to be a true blockbuster. And hopefully you, our listener, now have a front row seat to understanding the complex nuances that will define its next chapter.
And perhaps this leaves us with an intriguing thought for you to mull over. As India navigates these very unique, good problems challenges, literally born from its own success, what truly innovative, maybe even unconventional solutions might emerge? Could India actually create a kind of global blueprint for managing rapid growth and its inherent complex side effects? Something to think about.